Diversifying your investment portfolio is one of the key ways that you can handle market volatility.
This recession,
our economy could face.
We are way overdue for a major recession. Conventional wisdom says that what goes up must eventually come down, and that's especially true for investing in many cases.
that is true.
And we are coming out of the longest bull market in market history. But even if you view the market volatility as a normal occurrence, it can be tough to handle when it's your money at stake.
Too much money at stake.
While there's never going to be a foolproof way to handle the ups and downs of the stock market, the following timeless wisdom can help you navigate the craziness of markets that we've been dealing with recently. Number 1,
don't put all your eggs in one basket so early in life like I did, Sadie.
don't put all your eggs in one basket. Diversifying your investment portfolio is one of the key ways that you can handle market volatility, because asset classes often perform under different market conditions differently. Spreading your assets across a variety of different investments,
Stocks, bonds, objects of art, real estate,
has the potential to help you manage your overall risk. Ideally, a decline in one type of asset will be balanced out by a gain in another. That's really kind of the point.
Diversification.
And this is essentially the value of low-cost ETFs. Exchange-traded funds are a way to take advantage of the entire market's upside while diversifying your downside significantly.
I just feel like it's time to diversify my investments a bit, that's all.
If you've been following for a while, you know that my strategy is to position myself on the side of time. Meaning I'm looking for assets and strategies that allow me to use a long time horizon to my advantage. In my case, I know I can expect somewhere between an 8 to 10% return on ETFs, depending on the index I'm investing in. So if I consistently invest in the largest, most established indexes, and I stop being insane and checking every up and down in my stock portfolio daily, I can expect somewhere between 8 to 10% return over the long haul, most likely.
You really mean that?
Now, I'm obviously a massive fan of real estate investing. I'm very open about that throughout this channel. So I want to spend close to zero time with my other investments like ETFs. So if investing in ETFs gives me a pretty high degree of safety and a decent degree of returns and diversification away from real estate, even though it's a smaller piece of my portfolio.
It is important, Tony. You can't shame me into saying that it isn't.
Next insight is focus on the forest and not on the trees.
That's a good point. You should focus on that.
AKA make sure that you see the big picture when you're evaluating things and not just look at every minute detail and miss the overall trend that's going on before your eyes. As the markets go up and down, it's easy to become too focused on day-to-day returns. Instead, keep your eyes on your long-term investing goals and your overall portfolio.
And saying this every day reminds me to focus on the essentials.
Although only you can decide how much investment risk you can personally handle, if you still have years to invest on your time horizon, don't overestimate the effect of a short-term price fluctuation on your portfolio.
But I agree with you. They probably will be.
Most notably, always check the costs of different investments. For instance, some investment funds will charge fees like management fees, acquisition fees, and many others.
Well, I am not surprised.
While these may seem small at first, you know, 1% here, 0.5% there, they can actually make a massive difference over the long haul of your investing career. Like, let's say 30 to 50% difference over time when you account for the opportunity cost of the compounding returns that you could be experiencing without all those fees. After seeing the impact of fees on long-term investments, we literally made the fees zero for the same income fund for this exact reason.
That is awesome.
So make sure to check your own investments to understand what the fee structure is and what that impact would be to you over the long haul. Remember, it's not how much you make, it's how much you actually keep. Next insight
Behind every cloud, there's a silver lining.
is look for the silver lining. A down market, like every cloud, always has a silver lining. The silver lining of a down market is the opportunity that you have to buy assets at lower prices. One of the ways to do this is by using dollar cost averaging in a market. With dollar cost averaging, you don't try to actually time the market, timing the top and timing the bottom, because as we've covered, this never works out over the long term how people expect.
It will never work.
Eventually, the market always beats you. So in dollar cost averaging, you're not worried about buying shares at the absolute moment when the price is the lowest. In fact, you don't actually worry about the price at all for the most part. Instead, you invest the same amount of money at regular intervals over time. When the price is higher, your investment dollars buy fewer shares of that stock or investment. But when the price is lower, the same dollar amount will buy you more of those assets. Although dollar cost averaging can't guarantee you a profit or protect against a loss, over time, a regular fixed investment amount will likely return a market average return. This is actually good. This means you're getting exactly what you're expecting that you're going to get. So that amount of certainty and the increased certainty that you get from that is a value all on its own. Next wisdom to consider is don't count your chickens before they hatch. As the market recovers from a major down cycle, elation can quickly set in. If the upswing lasts long enough, like the last record-breaking bull market, it's easy to believe that investing will always result in a sure thing.
I find that very easy to believe.
Right? But of course, it never is a sure thing, is it? And many people are learning that right now. As many investors have learned the hard way, becoming overly optimistic about investing during the good times can be as devastating as worrying too much during the bad times. The right approach during all kinds of markets is to, let's be realistic,
Understand the market. I have a plan.
Stick with it.
and strike a comfortable balance between risk and return, one that you feel most comfortable with. And additionally, know when to consider a change in your game plan. During and after the pandemic, we realized something shocking in the Saint portfolio. Parts of our huge real estate portfolio were not performing that great, no matter how hard we worked or how genius we thought our game plan was. So why is that? Because the market had shifted and certain property types were not doing as well as others. So rather than saying, well, these properties have been amazing for so many years, so they 100% will have to be amazing again, right?
It did not happen to me.
We took a more realistic approach and we looked at the big picture and realized that our investment thesis had actually changed with the current market conditions. And we believed that the future would actually look quite a bit different than the past. So we spent over 2 years rearranging nearly 100 million in real estate assets. And you know what happened next? We experienced the best returns we had had in many years because we adjusted and got ahead of the major trends in the market instead of falling behind and being a victim to them. But the story could have been the complete opposite if we didn't evaluate and change our game plan with the new market information that we had. These pieces of timeless wisdom have helped me over and over throughout my investing career. Equally as valuable has been staying involved with a network with the best operators in the real estate industry. I recently attended a mastermind that I spent over $58,000 to learn from some of the best investors of our generation. And I want to share my personal notes that cost me tens of thousands of dollars with you for free. So comment notes below to get sent my private notes valued at over $58,000. And without a doubt, in this environment, you must absolutely understand the inflation picture we are all living in. I'm putting up a link to an extremely valuable presentation that we put together on inflation, where we put the inflation picture into the best explanation that I have seen anywhere. Check it out to protect yourself and your investments in the inflationary period we find ourselves in today.
Of inflation ahead, how to navigate this, how to manage your portfolio and invest through this.